The Federal Reserve just did something that matters more than most people realize. It did not cut interest rates. It did not raise interest rates. It decided to hold the system exactly where it is because the people running the system no longer agree on which danger is greater. That is the important part. Most people watch the Fed as if it is only deciding whether mortgage rates, car loans, credit cards, and stock valuations go up or down. That is the surface. The deeper issue is that the Fed is now caught between two large forces that are moving against each other. One force says the economy is weakening and needs relief. The other force says inflation and the dollar problem are still dangerous and need restraint. When a machine has two pressures moving in opposite directions, it does not simply become complicated, it becomes unstable. And when the central bank becomes divided at the same time, the government is carrying more than $39 trillion of debt. The issue is no longer just whether stocks go higher next week. The issue is whether the entire monetary system can continue to manage the cost of its own promises. That is what I want you to understand. There were three announcements that matter. The first is that the Fed is not cutting rates even though there is enormous pressure to cut. The economy wants lower rates. Politicians want lower rates. Borrowers want lower rates. Housing wants lower rates. Small businesses want lower rates. But the Fed did not cut. The Fed also did not raise rates. Even though inflation is still a problem and the dollar still has to be defended, it did neither. That tells you something very important. It tells you that the Fed is not acting from confidence. It is acting from uncertainty. When a central bank understands the environment clearly, it moves in a direction. When it is uncertain, it holds the line and waits for more information. That can be prudent, but it can also be a sign that the system is entering a zone where every choice creates a new problem. The second announcement was the internal split. The vote was unusually divided. That matters more than the headline. Some members believe rates should go higher to protect the value of the dollar and fight inflation. Other members believe rates should go lower to protect the economy from slowing too much. Both sides have a point. That is what makes this dangerous. When one side is obviously wrong, the system is easier to manage. When both sides are partly right, the problem becomes a genuine policy trap. If the Fed raises rates, it may help inflation, but it hurts borrowers, housing, businesses, asset prices, and employment. If the Fed cuts rates, it may support the economy, but it can feed inflation, weaken the dollar, and make the purchasing power problem worse. So the Fed is standing between fire and water. The third announcement was about Jerome Powell. His term as chair is ending. But he said he is not leaving the board while the investigation around him remains unresolved. That means his chairmanship may end, but his influence may remain inside the voting structure. And that matters because the Fed is not one person. The Fed is a committee. It takes votes. It has factions. It has personalities. It has institutional habits. A new chair has influence, but a chair does not become a king. Many people believed that once Kevin Warsh came in, the political pressure for lower rates would suddenly have a clearer path. But if Powell remains on the board, and if the vote is already divided, then that path becomes less simple. This is why I always say that you must not think in slogans. You must think in systems. A slogan says, new Fed chair, lower rates. A system says there are 12 voting members. There are inflation constraints, there are debt constraints, there are bond market constraints, there is political pressure, there is public confidence, and there is the global role of the dollar. Those things interact, and when they interact at the wrong point in the cycle, they produce outcomes that surprise most people. Now let us go deeper, because the biggest problem is not the meeting itself. The biggest problem is what the meeting revealed. The United States government has more than $39 trillion of national debt. That is money the government spent but did not generate through taxes. It borrowed that money from domestic investors, foreign governments, institutions, pension funds, banks, and the Federal Reserve System itself. Borrowing is not automatically bad. Debt can be productive when it is used to build things that produce future income. The problem comes when debt grows faster than the income that supports it. That is where the United States is now. The government is paying more than $1 trillion a year in interest on the debt, not principal interest. Think about what that means. A large share of tax revenue is no longer going toward roads, defense, research, infrastructure, education, or direct public services. It is going toward paying interest on promises already made. Roughly 20 cents of every tax dollar is now being pulled into the interest machine. That is a structural problem. When the government owes a manageable amount of debt, the Fed can focus mainly on inflation and employment. But when the debt is so large that interest payments become one of the biggest items in the federal budget, the Fed's decisions begin to affect government solvency pressures directly. That is the shift. The Fed is no longer just managing the economy. It is increasingly managing the debt cost of the government, the confidence of the bond market, the value of the dollar, and the political pressure that comes from all of it. That is what I call a net interest trigger. At a certain point, the cost of interest becomes so large that it starts to change the behavior of the entire system. The government needs lower interest costs. Borrowers need lower interest costs. The economy wants relief. But the dollar and inflation may require higher interest rates. That is the trap. If rates stay high, the government pays more on its debt. Businesses pay more to borrow. Mortgages stay high. Consumers slow down, and the economy weakens. If rates fall too quickly, inflation may accelerate, the dollar may weaken, and the real value of savings may decline faster. So the question is no longer simply should rates be high or low. The question is which pain will the system choose and who will absorb it? That is always the real question in monetary policy. There is no pain-free path. There is only a question of distribution. Who pays? Savers can pay through inflation. Borrowers can pay through high interest rates. Asset holders can benefit if liquidity returns. Workers can pay if unemployment rises. Taxpayers can pay if debt costs consume more of the budget. Bondholders can pay if real returns turn negative. Most people do not see this because they look at the Fed as if it is making technical adjustments. But in reality, interest rate policy determines how pressure moves through the system. Now let us talk about Kevin Warsh. Because the proposed direction is interesting and difficult, Warsh has talked about cutting interest rates while shrinking the Fed balance sheet at first. That sounds like a way to get the best of both worlds. Lower rates would make borrowing easier. Mortgage rates could come down. Business loans could become cheaper. Consumer credit could ease. Asset prices could get support. The economy could breathe. At the same time, shrinking the balance sheet would remove money from the system, which could theoretically reduce inflationary pressure. So the idea is simple. On the surface, cut rates to help the economy, shrink the balance sheet to fight inflation. But systems do not always respond to intentions. They respond to mechanics, and the mechanics are much more difficult than the slogan. To understand this, you need to understand what the Fed balance sheet actually means in practice. The Federal Reserve has created money and used that money to buy government debt and other financial assets. When it buys Treasury securities, it is effectively providing demand for the government's borrowing. That helps keep the bond market stable. If the Fed shrinks its balance sheet, it sells securities or allows them to mature without replacing them. That means one large buyer is stepping back from the Treasury market. And if one large buyer steps back, someone else has to step in. If there is enough private demand, then maybe yields stay controlled. But if there is not enough demand, the government must offer higher interest rates to attract buyers. That is where the risk is. Warsh says private demand may be strong enough, perhaps it will be, but if it is not, then shrinking the balance sheet can push Treasury yields higher, and Treasury yields are not some isolated number on a screen. They are the foundation of the entire credit system. Mortgage rates are priced off Treasury rates. Auto loans are influenced by Treasury rates. Corporate borrowing costs are influenced by Treasury rates. Credit card rates are affected by the broader rate environment. Business loans, municipal bonds, insurance portfolios, pension discount rates, valuation models, and equity risk premiums all connect back to the so-called risk-free rate. The risk-free rate is not just a rate. It is the base layer of modern finance. When that base layer moves, everything else reprices. That is why shrinking the balance sheet while cutting rates is not easy. You may lower the policy rate at the front end, but if the bond market demands higher yields at the long end, mortgage rates and borrowing costs may not fall the way people expect. That is the part most people miss. The Fed can influence rates, but it does not fully control the entire curve forever. The bond market has a vote, and the bond market votes with confidence or fear. If investors believe the United States can manage its debt, inflation, and currency stability, they accept lower rates. If they become nervous, they demand higher compensation. That is how every borrower is treated. If a borrower looks safe, lenders accept a low rate. If a borrower looks risky, lenders demand a higher rate. The United States has benefited for decades from being treated as the safest borrower in the world. That is an enormous advantage, but that advantage depends on trust. Trust in the dollar. Trust in the rule of law, trust in institutions, trust in the depth of the Treasury market, trust that inflation will not destroy the real value of the payments. When trust weakens, rates rise even if policymakers want them lower. That is one of the most important principles in this entire situation. You can print currency, but you cannot print trust. You can announce policy, but you cannot command confidence. The source text also points to something that matters emotionally and practically. People feel inflation differently than official numbers show. That is true in the way ordinary people experience the world. A published inflation rate is an average. Your life is not an average. If your rent, insurance, groceries, car payments, property taxes, and utilities have risen much faster than the official number, then your personal inflation rate is much higher than the headline rate. This is why many people feel poorer even when they are told the economy is fine. Their paycheck may be larger in nominal dollars, but the goods and services they need most have become more expensive. Their savings balance may be higher, but what that balance can buy has declined, and that is what matters. Wealth is not measured in dollars, it is measured in purchasing power. If you have more dollars but less purchasing power, you did not become richer. You became poorer in a quieter way. That is why inflation is so politically powerful and socially corrosive. It makes people feel as though the rules changed after they did what they were supposed to do. They worked, they saved, they avoided risk. Then the currency itself lost power. That creates anger, and policymakers know that. So when Warsh talks about redefining inflation, or reducing press conferences, or abandoning forward guidance, the issue is not just technical. It is about how the system communicates reality. Inflation measurement has changed over time. Housing is measured in ways many ordinary households do not intuitively recognize. The cost of ownership, insurance, taxes, rent, and replacement costs can feel far more severe than the index suggests. When people hear that inflation is 3%, but their life feels 10% more expensive, trust declines. And when trust declines, policy becomes harder. Forward guidance was meant to help markets understand where the Fed was going. It was meant to reduce uncertainty, but guidance can also trap a central bank. If the Fed says too much and the world changes, it loses credibility when it has to change direction. Reducing guidance may give the Fed more flexibility, but it also gives markets less clarity. That means more volatility. And volatility is not a bug in a shifting system. It is often the way the system finds a new equilibrium. This is why investors must think differently. Now, you cannot simply ask whether the Fed is cutting or raising. You have to ask what problem the Fed is really trying to solve. Is it trying to protect employment? Is it trying to reduce inflation? Is it trying to keep the Treasury market functioning? Is it trying to keep the dollar trusted globally? Is it trying to reduce the government's interest burden? Is it trying to support asset markets without saying so directly? Often the answer is more than one of these at the same time. That is why the choices look inconsistent. They are not always inconsistent. They are attempts to satisfy conflicting constraints. Now let us connect this to your paycheck, because this is where the abstract becomes personal. If the Fed cuts too aggressively and inflation rises, your paycheck loses value unless your income rises faster than your cost of living. If the Fed stays tight or raises rates, companies may hire less, invest less, and cut costs. That can affect jobs, bonuses, business formation, and wage growth. If Treasury yields rise, mortgages stay expensive, housing affordability stays strained, and the cost of debt across the economy remains heavy. If the Fed shrinks the balance sheet and private demand does not absorb the Treasury supply, long-term borrowing costs can rise even while the Fed claims it is easing. If inflation is redefined or communication changes, markets may have to relearn how to interpret the Fed. All of this connects to the value of your money. This is why people who only work for wages and hold their savings in cash are vulnerable. In a system like this, I am not saying that everyone should speculate. That is not the point. The point is that cash and wages alone are claims on a currency that can be diluted by policy choices. If your assets do not grow faster than your real cost of living, you are losing ground. That is the central principle. Most people think risk is only the possibility that an investment goes down. That is one kind of risk. But there is another risk that is more common and more invisible. The risk that you hold what feels safe while its purchasing power declines. The risk that you avoid volatility but accept guaranteed erosion. The risk that you wait for clarity. And by the time clarity arrives, prices have already adjusted. That is why I always think in probabilities, systems, and cause-effect relationships. The Fed is not operating in a vacuum. It is operating inside a debt cycle, an inflation cycle, a political cycle, a geopolitical cycle, a technology cycle, and a confidence cycle. When those cycles line up in one direction, the environment is simple. When they conflict, the environment becomes fragile. We are in a fragile environment that does not mean collapse tomorrow. It does not mean panic. It means you must understand the machine before it moves against you. The machine has several parts. The government spends more than it collects. The gap becomes debt. The debt requires buyers. Buyers require confidence. Confidence depends on inflation, currency stability, and policy credibility. The Fed affects all of these variables, but cannot control all of them perfectly if it cuts. Inflation risk rises. If it hikes, recession and debt service risk rise. If it holds, both risks remain unresolved. That is the situation. Holding rates steady was not an absence of action. It was a signal that the Fed does not yet know which risk it is willing to prioritize. That is a very important signal. When central bankers disagree sharply, you should not pretend the environment is normal. You should ask what each side is afraid of. The side that wants higher rates is afraid of inflation and dollar weakness. The side that wants lower rates is afraid of economic damage and debt. Service stress. Both fears are rational. That means the range of future outcomes is wide. Wide outcomes require resilience. For an individual, resilience means several things. It means not carrying unnecessary high-interest debt when the rate environment is uncertain. It means not relying only on cash that can be eaten by inflation. It means not concentrating all wealth in one asset that depends on one policy outcome. It means understanding the difference between nominal income and real purchasing power. It means realizing that the bond market matters as much as the Fed's statement. It means watching not just what policymakers say, but what constraints force them to do. The most dangerous investors are not the ones who admit uncertainty. The most dangerous investors are the ones who believe a single political appointment or a single Fed meeting will solve a structural debt problem. The debt problem is much larger than one person. A chair can influence the path, but the debt cycle defines the field. That is why Powell staying on the board matters, but it is not the whole story. Warsh entering matters, but it is not the whole story. The vote split matters, but it is not the whole story. The whole story is that the United States is trying to manage a large debt load in a world where inflation is not fully defeated. Oil shocks can still move prices, labor and AI are changing employment. Housing is still strained. And confidence in money is becoming more important. This is the environment in which your paycheck, your savings, your mortgage, your portfolio, and your future decisions will be shaped. So do not reduce it to a headline. Think in chains. Higher oil can raise inflation. Higher inflation can prevent rate cuts. No rate cuts can pressure housing and business borrowing. Higher debt costs can pressure the federal budget. A pressured budget can create pressure for easier money. Easier money can weaken purchasing power. Weaker purchasing power can push people toward assets. Asset inflation can make the wealthy feel richer while wage earners feel poorer. That is the chain. If you understand the chain, you can stop being surprised by the outcomes. Now, I want to end with the most practical point. The Fed's decisions affect the economy, but your response to the environment affects your life. Most people will wait for a clear answer. They will wait for Powell to leave. They will wait for Warsh to act. They will wait for the first cut. They will wait for inflation to be declared solved. They will wait for the news to tell them that everything is safe. That is usually the wrong way to live through a transition. By the time the news tells you the environment has changed, markets and institutions have already adjusted. The goal is not to predict every Fed move. Nobody can do that consistently. The goal is to understand the pressures and build a financial structure that can survive multiple outcomes. If inflation stays high, you need protection from currency erosion. If rates stay high, you need discipline around debt and liquidity. If the economy weakens, you need resilience and optionality. If asset prices move higher because policy eventually eases, you need exposure to productive assets. If volatility rises because communication changes, you need the ability not to panic. That is the balanced way to think. The Fed just showed us that the center of the system is divided. It showed us that the old simple story, cut rates when the economy slows and raise rates when inflation rises, is no longer enough. The debt burden has become too large. The interest cost has become too visible. The bond market has become too important. The dollar's role has become too central. So the system is entering a period where policy will be harder to read, where official inflation may not match lived inflation, where the value of a paycheck will depend on more than the number printed on it, and where the difference between savers and asset owners may become even more important. This is not a reason to be afraid. It is a reason to become more awake. The people who do best in changing systems are not the people who know every answer. They are the people who understand the machine, see the constraints, respect the risks, and act before the consequences become obvious. That is what matters now. The Fed did not just hold rates, it revealed the trap, and once you see the trap, you can begin making decisions that are based on reality instead of comfort.